Right, so everyone talks about the S&P 500, but only a few people can actually explain what it really measures. It's not just a list of big companies, and it's not exactly the same thing as the stock market itself. Behind that number, there's essentially a precise formula that moves trillions of dollars every single day, and it shapes how portfolios rise or fall worldwide. So by the end of this video, you'll understand exactly what the S&P 500 is, why it matters more than any other index, and how it quietly drives nearly every single market move that you see. Right, so let's just have a look at some quick history. So the S&P was actually launched in 1957, and it was built by a company called Standard & Poor's as a sort of broad stock market index. You probably realize by now that S&P stands for Standard & Poor's. Before that, most people were tracking the Dow, which was only 30 companies. So the S&P sort of changed the game because it covered 500 of the largest US companies across every single major sector. And today it's the world's most traded index. So when you sort of hear people say the market is up, they're almost definitely talking about the S&P 500 being up. So here's how it's built. The S&P 500 is a market cap weighted index. That means that the bigger companies carry the majority of the weight in the index. So the technology sector does contain the majority of the weight. That's why you sometimes hear people talk about breadth. And all that means is how many stocks are actually participating in the rally. So the S&P might be making new highs, but if only 20 stocks are pushing it to the new highs, that's sort of fragile. Now let's look at what actually moves the S&P 500. So before that, we need to understand the SPX. The SPX is just a shorthand for the S&P 500 index level. And that value, that number that you see, is just ultimately driven by two things: earnings and valuation multiples. So think of it this way: SPX is equal to the earnings multiplied by the multiple. So the earnings is just the profits of the 500 top companies in the index. And the multiple is essentially how much investors are willing to pay for those earnings. And this is often expressed as the PE ratio. So if earnings grow, the index tends to rise. If valuations expand, for example, when the interest rates are low, investors are willing to pay more. The index can rise even faster. But when rates rise or recession fears hit, multiples compress, essentially the index falls, even if earnings are steady. That's why traders sort of obsess over both earnings season and Fed policy, because together both of them determine the path of the S&P 500. Okay, so now let's look at macro drivers, why the Fed and the yields matter for the S&P 500. So as you know now, the S&P 500 doesn't move by itself. It lives in a sort of macro ecosystem, and there's certain factors that influence its price. The first being interest rates. Higher interest rates usually hurt valuations massively, which means that the S&P will retract. Bonds and yields. If the 10-year yield spikes, equities again, they often pull back. The US dollar. If you have a strong dollar, it essentially adds a lot of pressure on multinational companies because since they're overseas, the profits shrink when they're converted back to the dollar. And that can essentially harm the earnings. And of course, inflation data. Hot CPI means that there's a lot of spending going on in the economy. In order to curb that, the Fed may have to raise interest rates. And if they raise interest rates, the index will pull back. So if we go on to the next topic, breadth, internals, and sentiment. So the index itself is just one number. But to understand the quality of a move, is it strong, is it weak, is it broad, narrow, professionals use sort of indicators to gauge how strong it's going to be. The first being breadth indicators, such as the advanced decline lines. All this is, it just shows how many of the stocks are actually rising compared to the amount of stocks that are falling. Second, the equal weight S&P 500, essentially the RSP ETF. All that does is it strips out the mega cap dominance and gives every single stock the same weighting. And the third, volatility measures like the VIX, which are based on the S&P 500 options. This is very important. A lot of people that trade the S&P 500 also watch the VIX, and they essentially watch it to gauge fear and complacency. Right, so I've just opened up the charting, and on the left-hand side we have the SPY, which is the ETF version of the S&P 500, and on the right-hand side we have the VIX, which is essentially a measure of the expected volatility in the S&P 500. So a lot of SPY traders, they look at the VIX, and that's because the SPY and the VIX, they have an inverse relationship. So if the SPY rallies, the VIX will pull back. And if the SPY falls, the VIX will rally. And if I just open up the charting tool, you can see this very clearly here. The shape of the SPY and the shape of the VIX essentially are just inverses of each other. So we can use this inverse relationship and levels on the VIX to essentially aid our trading decisions and determine where the SPY will go next. So of course here on the SPY we have a rally which shows us a pullback on the VIX. And here on the SPY we have a pullback which shows us a rally on the VIX. So we can essentially use both charts to aid our trading. So why does this matter? Well, because a rising index with weak breadth often breaks down later. It's a weak move. And when volatility spikes, correlations across stocks go to 1, meaning everything moves with the S&P. So the index tells one story, and the internals sort of tell you whether the story is real or not. The S&P 500 isn't just for US traders and people living in the US. It's a global indicator. It has a global impact. International investors use it as a reference point for US equities. Central banks and sovereign wealth funds also hold it. And even Bitcoin and commodities often trade inversely or in sync with S&P risk. So when the S&P weakens, the rest of the global markets also weaken. So it's all good understanding how it works and what the S&P 500 is and what its components are. How do traders access it? So you can't actually buy the index itself. It's just the number. But you can essentially trade products built on it. So what do we have? We have the SPY ETF, which is the most popular fund. Basically trades like a stock. We have SPX options used by institutions, hash settled, huge contract sizes. We have ES futures, they're leveraged, nearly 24-hour access. Of course, we have the US 500 CFDs, they're very popular outside of the US. Each of these products in itself deserves its own video. Just know whatever your style is, there's a way to trade the S&P 500.